For the last decade, India has been a massive buyer of renewable energy hardware. Now, they are commissioning the capacity to build that hardware themselves. This shift is a direct result of a policy change. The Indian government automated the flow of capital by allowing 100% foreign direct investment, or FDI, through an automatic route. Eliminating the requirement for prior government approval has attracted a specific wave of capital: foreign institutional investors, private equity firms, and multinational energy corporations. But arriving with capital is only the first step. The challenge for these institutions is deciding exactly where to deploy it in a market moving this fast. Investors are forced into a strict binary choice. Do you secure a foothold in a mature supply chain trying to compete with China, or do you navigate the high-risk, unbuilt infrastructure of a completely new frontier? This chart illustrates the first path: solar PV manufacturing. Projected capacity is hitting 1444 gigawatts, while domestic demand sits at just 40. That overcapacity squeezes domestic margins. To survive, that surplus must be pushed outward into export markets like Europe and Africa. The second path is green hydrogen. This is the high-growth frontier play aimed specifically at decarbonizing heavy industry. Here's the descending line graph showing the primary hurdle for hydrogen. Current production costs are hovering around $4 to $5 per kilogram. To compete with fossil fuels by 2030, that cost has to drop to a target of $1 per kilogram. So the trade-off is clear. You either take on execution risk in a heavily oversupplied solar market, or you take on technology risk in a nascent hydrogen market that doesn't fully exist yet. Looking closer at solar, the engine driving this oversupply is the Production-Linked Incentive, or PLI, scheme. The government has committed an outlay of 24,000 crore rupees to kickstart domestic production. The PLI structure doesn't reward basic assembly. It specifically demands fully integrated manufacturing facilities, taking raw polysilicon all the way to finished modules. The strategic intent here is direct. India wants to establish itself as a viable, scaled alternative to China for global solar supply chains. These incentives have driven the manufacturing capacity target up to that 144 gigawatt mark. Meanwhile, local demand remains pinned near 40 gigawatts. That leaves a 100 gigawatt gap between what Indian factories can produce and what the Indian grid can absorb. With that much localized supply competing for a limited pool of domestic buyers, profit margins within India will compress. The only mathematical path to profitability is pivoting away from domestic sales and targeting high-margin export markets in Europe and Africa. Deploying capital into Indian solar is no longer a localized energy play. It is a hyper-competitive global export battle, and winning requires you to bring pre-existing international distribution networks to the table. Green hydrogen relies on a different financial catalyst. The government's SITE program provides direct subsidies for production rather than just building factories. Specifically, producers can secure a direct subsidy of up to 60 cents per kilogram of green hydrogen produced. There is also a significant operational benefit: a 25-year waiver on interstate transmission system charges, which lowers the cost of moving the renewable power needed to make the hydrogen. The target buyers for this subsidized fuel are heavy industrial sectors, like steelmaking, that currently rely on fossil fuels. The prize for investors is an early mover advantage in decarbonizing massive global supply chains across steel, shipping, and fertilizers. But you still have to clear that immediate cost barrier, bridging the gap from today's $4 to $5 production cost down to the $1 fossil fuel parity. Even if you hit the price target, there is a physical bottleneck. Exporting green hydrogen requires specialized port facilities that are largely still under construction. That creates a strict timeline constraint. Investors are waiting for massive capital projects to mature, which pushes realistic returns out toward the 2030 horizon. Hydrogen demands patient capital. You have to be capable of absorbing high upfront costs and holding your position while waiting for port infrastructure and cost parity to catch up. Beyond the technology, we have to look at the execution layer. Foreign capital still has to navigate the Indian regulatory framework to actually break ground. Individual states provide targeted fiscal incentives to attract your capital. You will see 100% stamp duty exemptions on land purchases and electricity tax waivers. But the automatic FDI route contains hidden friction. To clear compliance, funds must provide deep upstream shareholding disclosures to the government. The specific burden lies in proving significant beneficial ownership. Tracing exact control rights and voting arrangements lengthens the legal diligence phase for foreign funds. The reality is that massive on-paper subsidies and fast tracks are frequently offset by back-end compliance bottlenecks. Deploying capital is much more complex than the headlines suggest. This comparison matrix shows the two sectors head-to-head. Your first step is matching your firm's operational strengths to the primary subsidy vehicle. Solar PV is driven by the PLI, which rewards scale. Green hydrogen is driven by sight, which rewards actual output and production. Looking at target ROI timelines, the divergence is sharp. Solar offers short to medium-term returns based on immediate supply chain execution. Hydrogen requires a long-term outlook, banking on tech development maturing post-2030. Then you factor in the primary bottlenecks. Solar investors must survive intense export market competition, while hydrogen investors must wait on unbuilt port infrastructure. It forces a structural choice. You must commit to either fighting a brutal supply chain war today or financing a technology scaling game for tomorrow. This quadrant chart plots effort and execution risk against time to maturity. Solar PV manufacturing plots here, in the low time, medium risk quadrant. The ideal investors are established global manufacturers and private equity funds that already have international distribution networks. If your firm lacks export capabilities and is relying solely on the Indian domestic market to absorb your product, the margins will not hold up. Green hydrogen infrastructure plots in the high time, high risk quadrant. This is built for long-term infrastructure funds, sovereign wealth funds, and energy multinationals securing a multi-decade moat. If your fund has a strict 3 to 5 year liquidity mandate, this is a mismatch for your capital. India offers the policy incentives and the scale to build a clean energy portfolio, but success requires aligning your firm's internal mandates and risk tolerance with these physical realities before deploying a single dollar.